You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. Thank you for being here. Thank you for listening in. I appreciate you taking the time to learn about infinite banking. I'm so happy for you that you are taking the steps to learn about it. It is definitely one of the most exciting and amazing things I've ever learned, and that's why I love to teach it. So today I wanted to talk about, if my premium must go down, how does my banking system grow? Oftentimes when I am meeting with a client and we're going over an illustration or talking about their illustration, they will ask, why is the premium going down? How am I supposed to grow this? If the premium's going down, am I able to add more premium? And so the answer really is, to make your banking system grow, yes, you should add more premium. You should be putting in more premium dollars. Premium is the way to grow your overall banking system. However, you are not able to continue adding more premium, more paid up additions into the same contract, into your initial contract, into each contract that you started. No matter the contract, whatever number you start with, we are starting at the ceiling. I am building your contract to start right at the MEC ceiling. Remember that MEC stands for Modified Endowment Contract. And what that means is we want to stay under that MEC ceiling to keep your policy growing and accessible, income tax free. If we cross that MEC line by putting too much money into the contract, it will become taxable. The whole thing will become taxable. Loans will become taxable when you take out the earnings of your contract. So we really want to watch the MEC line. If you put too much money into your contract, you will cross over that MEC line and it will become taxable. So when I'm building a policy, I'm usually building it so that you can fund it for a certain amount of years. That is a specialized thing as well. We can build it to be funded for an amount of years that you would like, or maybe you're unsure, so we build it out longer. That is kind of a personalized thing that we look to see what you're budgeting, what your budget looks like, how much you think you'll be able to fund the contract, what amount you think you'll be able to fund and for how long. So we're building it, we're specializing it to fit your needs and your budget and your plan for funding premium. There is some flexibility in that, of course, where you're not required to pay whatever we start with indefinitely or for the amount of years that we've illustrated. You definitely have flexibility. But at some point in the future in that contract, you will have to drop the paid up additions portion of the premium. Remember that there are two parts to the premium. There is the base premium, which is supporting the actual death benefit. And then there is the paid up additions portion of the premium that is overfunding the contract. That is the cash that you're putting in that's going directly to cash value that you have access to right away in the first year. So you have those two parts to the premium and you're able to fund those for a while, as long as we build the contract. That's the part we're going to discuss and talk about. How long can I fund that extra paid up additions and how long do you want to be able to fund it? That's one of the specializations when we are working together and building your contract. But at some point you will have to drop it off. So then people will say, well, if I was paying $20,000, $40,000 a year, whatever it is, $10,000, $5,000, if I'm paying this amount per year, let's just say $20,000, and at year 10, let's say, it's showing that I'm going to have to drop the premium down to $8,000. But let's say in 10 years, I actually can continue funding at $20,000 or maybe even more. Maybe I've had an increase in income, my kids moved out, whatever it is, I paid a bunch of stuff off. Maybe I can fund higher than $20,000. What do I do then? Can I put it into the contract? Can I keep funding it at $20,000 a year? How do I continue to fund it? Or if I want to fund $30,000, can I put $30,000 into the contract? The answer is no. When you start your contract, again, that is your ceiling. So you would have to start a second contract in order to continue funding at that level you started with or to fund at a higher level. So if you happen to have or have read Nelson Nash's book, Becoming Your Own Banker, you want to flip over to pages 60 to 62. You can see he starts funding off those policies with $40,000 a year, and then later on it's increasing. It's a pretty high number he continues to fund with. On one of the illustrations, he continues funding at $36,000. On another one, it's $54,000, and then it increases some more. Well, he actually built those illustrations to show what would happen within more than one contract, because you would not be able to do that in one contract. You cannot have a very high premium close to what you started with ongoing for the life of the contract. That's not going to work. So the convenient part of looking at those illustrations that he built for his book is that he is illustrating more than one contract, but showing you all in one so you can see how amazing it is and how amazing it works and how everything works all together. Because looking at just one contract isn't in itself going to look super amazing. If you end up with more than one, which you may or may not, maybe one for you and your spouse and your kids, a parent, then you will combine all those pools of cash and that will be your total. So if you want to end up with a larger pool of cash, in the end, a larger banking system, you will likely end up with more than one contract. So if you're looking at one illustration, you're working with your advisor, you're looking at one illustration or working with me, and you're wondering, how can I grow my system when I can visually see here that I'm going to have to lower my contribution to the plan? The answer simply is more premium. Start a new contract. When you are borrowing against your contract and paying yourself back with interest, don't forget with interest, when you're paying yourself back, that is a form of being able to use your banking system so that it allows you to be able to fund higher, because the money isn't being trapped away like it is in a retirement plan. When you're saving into a retirement plan, you don't have access to that cash. It's not accessible till you hit your retirement years, so it's a little harder to save a large amount. But when you have access to all the money, it's a little easier to save higher. And while you're doing that, remember, you're trapping all that money into an account that's going to earn on a guaranteed basis for the rest of your life and be earning dividends. But you do want to be sure to be paying yourself back. So you're stocking a lot of money away, paying yourself back with interest so that you're recycling your own money, and it allows you to save more because you have access to it and you're able to pay it back. You want to make sure you're paying it back so that you have use of it again and again throughout your life, and of course, again in retirement. But the key to actually growing your system is to be paying as much as you can in premium, essentially. So when you start taking over your debts or the investments that you want to purchase, you're running them through your system, you're putting the money in, you're borrowing it out to buy investments. When you're doing all that, so as an example, you fund a bunch into your system, you start taking over your debt, you start paying off your debt to outside banks using your banking system, and then you start paying yourself back either the same amount you were paying to those other creditors or to those bank loans, or whatever number you come up with, whatever amount of payment you want to set for yourself. But once that debt is paid off, and maybe a lot of your debts are paid off, all your debts are paid off, or whatever you use that money for is all paid back, but you're used to making that monthly contribution as a loan repayment to replenish those funds, where does that money go now that my loans are all paid back? Good place to go is a new contract, new premium, because at the end of the day, you're going to have a pool of cash in a contract, but wouldn't you like 5 pools of cash instead of just one? Because we can't stuff it all into one. We can't make one really, really big, because that contract will then become a modified endowment contract. It will MEC and become taxable. And then we will have to pay tax on all of our gain. So we do not want that to happen. Oftentimes when I'm talking to clients, I am sharing how it's a good idea to have some term insurance, also for just more coverage to cover your family at a higher level, because oftentimes the amount people are contributing or purchasing with their whole life policy does not yield a very large death benefit because of the way we're building it. We're building it to shrink down the death benefit on purpose so that your cash grows more efficiently. So that oftentimes limits the death benefit. So in addition to having some term insurance to increase that total death benefit, it will be there to be able to convert later on when your paid up additions has to drop off. You're able to convert that into a new contract. And now you have converted another chunk of life insurance into a contract that will be guaranteed to pay a death benefit to age 121 rather than term, which drops off 10, 20, 30 years. It's, not going to last your whole life. So you want to lock in as much whole life as you can to benefit your family. But in the meantime, even if there was no death benefit, your contract will be amazing. The death benefit ends up almost being kind of like a side effect for a lot of people. It's obviously a focus for a lot of people, but it also can be more like a side effect because we're excited and we're looking at the cash efficiency and running our money through our banking system to capture as much interest and dividends as we can on that. You have to think of it like, where are you going to store your money? Where do you want to store your cash? Do you want to store it at Bank of America, Chase, some other bank, someone else's bank, or your own banking system? Where do you want to store your cash? If you had an actual physical bank, would you be putting your money in someone else's bank or would you be putting it in your own bank? So I'd rather house all my money through my own bank. So that's where all my savings goes. It goes into my own banking system, and then I use it from there just like I would from any other bank. At the end of the day, it really is up to you how your banking system is going to function. It's up to your actions, what you're doing. A lot of people, they want to compare illustrations, talk to a bunch of advisors and this and that, think one company is better than another. The life insurance companies that are mutual are all pretty strong. They're great. They are the backbone of America. So of the financial system in America, they are strong. So it's kind of like comparing Microsoft and Apple and Google and Facebook, like all these large companies that are strong. They may have different quirks, different things, different little details that are different, but mostly they're good. Most of them are pretty good. So what you're looking at when you're trying to decide what contract you'd like or who you'd like to work with, I wouldn't be looking at comparing dividends and all that because the dividends, remember, are not guaranteed. They are going to be paid based on how the company did. And so guarantees, that's important. It's going to have a strong guarantee because when I'm talking about my banking system, I want my guarantee to be very strong. That's something that's going to be there for sure, as opposed to the dividend. We don't know what it's going to be. And some companies illustrate higher than others, and some companies take more risk in order to be able to offer a higher dividend. And I don't want my insurance company and my banking system taking any risk. I want it to be as low risk as possible. I can take risks somewhere else with a different type of investment. So instead of focusing on the dividends and which one's a little bit higher or whatever, I would be focusing on finding an advisor you like, you trust, someone that you believe is looking out for your best interest, who's building the plan to fit your needs, your goals, how you think you can budget, and making sure it's a good fit for you. One who will be there and continue to be able to be there to continue to coach you, not just going to disappear, say hello, thank you, here's your contract, see you later. You want to work with someone who will be there to continue to offer you help as you build your system and grow and maybe build more than one banking plan. Someone you can go to for questions and make sure that you're staying on track. You want to work with an advisor who values your education, who is a good teacher, who wants to teach you, who wants to make sure you understand and answers your questions, and just doesn't rush you through the whole process. Well, that's all I have for you today. I hope that it was helpful, and I look forward to talking to you again next week. Of course, if you would like to connect, would like my help as your advisor, would like me to talk with you and work with you and help you understand, help clarify things for you and see how this infinite banking can work for your family, or if you've read Becoming Your Own Banker and would like to go over that, feel free to reach out. We can have a consultation and I can answer your questions. We can talk it through and see how this could work for your family. You can reach me at Valerie@alphaomegawealth.com. I hope that you have a great week. I will talk to you again next time. Take care.
This is thepodcastfactory.com.